All right, moving on from the operational updates to RBI releasing draft rules on external commercial borrowing. RBI has gone ahead and suggested a market-linked framework for the same. My colleague Anirag Joshi is now joining us with the details.
The Reserve Bank of India has proposed relaxing norms for local companies seeking to raise funds overseas through the external commercial borrowings. According to the new rules which the Reserve Bank has proposed in its draft guidelines, eligible borrowers are allowed to raise up to $1 billion or the outstanding borrowing up to 300% of the net worth, whichever is higher. And this compares to $750 million which was permitted in a financial year under the automatic route currently. The borrowing costs currently has a cap of 450 basis points over the benchmark rate, which can be SOFR or it can be the comparable INR rate. Now RBI has proposed that instead of having a cap, the borrowing cost will be based on the market interest rates. So the market yields will determine the borrowing costs for the Indian corporates. The minimum maturity proposed now is the minimum average maturity of 3 years on the borrowing, and this compares to the current rule which says that it is 3 years of minimum average maturity, but the RBI also allows 5 to 10 year maturity for some restricted uses. The eligible borrowers list has also been expanded, and this compares to specific categories of FDI eligible entities which are allowed to borrow currently.
All right, moving on then, it is the beginning of...
If you like this video, then like, share and subscribe to ET Now.